This channel is all about creating cash flow for the average Joe. And in this video, I want to share with you two additional new unique opportunities to utilize dividend stocks and juice the returns. And when I say juice the returns, I mean 40% annualized yields up to as high as 90 to 100%. Another quick reminder for you guys, if you're not part of the awesome Patreon community, and I do mean it's awesome, not because of me, because of all of the amazing other investors in this community that are at all different stages of the learning process and are taking action in their own portfolio. You of course get access to all of my portfolio updates as well. If you want to learn more about how to join the Patreon community, check out the link in the description below. Alright, the first stock we're talking about today with a unique opportunity coming up is ExxonMobil Corporation. Ticker symbol XOM. XOM is currently priced at 107.12, which is a yield of 3.39 or 3.4%. The next upcoming dividend is 91 cents, which they announced on July 28th, and the ex-dividend date is August the 15th, meaning you have to be the owner by end of trading August the 14th in order to be eligible for the dividend. Enter the dividend capture income calculator. I like to call this strategy the dividend espresso method or the dividend espresso strategy, where in advance of a dividend, not right before, not just to capture the dividend, but in advance of the dividend, we buy a stock with the goal of collecting the dividend because we own it prior to the ex-dividend date. And then number two, right after we own the shares, we sell a covered call, which is income we get to keep no matter what happens in our strategy. And potentially, depending on how we write the option, we may also have the opportunity to collect some capital appreciation. It's a triple threat. It's worked out multiple times for me, and I want to share with you how I've jumped into this stock and how you can too. Okay, so here are the details. Number one, we have the current price of ExxonMobil. We also have the next dividend amount and when it goes ex-dividend. We also need to get some option premium. Here is the option chain for ExxonMobil. We technically have three upcoming opportunities with respect to strike prices, expiring August 4th. We also have expiring August 11th and expiring August 18th. The dividend is going to be paid August the 15th. So in this specific scenario, August the 18th makes the most sense because that's going to be just after the ex-dividend date, although you could in theory go out to as late as August 25th. Since the ex-dividend date is the 15th, I went with the 18th for this example, but you could go out even further to August 25th for even more option premium. So current price 107.12. And for August 18th, 14 days away, we can choose to utilize right around the money, right here at 107, or we can choose a strike price of 108 or 109. If we use 108 and 109, we also are going to capture some capital appreciation if we get assigned at the end of this time frame. If we go with 107, we're not going to capture any capital appreciation, but because this number is below what the current market price is, we are compensated for that extra 12 cents in the price. And then here are the option premiums right here. So let's work with 109 on the strike price, and then we'll work with option premium of $95 to $100. We'll work with $97. All right, so all of our details are filled in here. We've got today's date, we've got the current price, we're going to assume we buy at 107.12. We've got a dividend, we've got the ex-dividend date, the strike price, and the option expiration with the option premium. Now, if we were to buy ExxonMobil, one of three scenarios is going to happen. Number one, the price never reaches 109, or it could even drop, in which case we're still going to hold XOM at the end of the period. And the truth is, the price of XOM could go down hard, in which case we have to be okay with owning ExxonMobil long-term if necessary. This is why the very first thing we do before we initiate this strategy is we pick quality dividend stocks that we are okay with owning long-term if the price drops. If you're not comfortable with that, I would highly discourage you from even utilizing this strategy. But in that scenario, if we don't get assigned and the price of ExxonMobil stays below 109 or even drops, we're still going to capture that dividend of 91 cents per share or $91 if we buy 100 shares. We're going to collect this option premium of $97 as well, and then how much capital appreciation we capture is just going to depend on when we sell the stock. Now, scenario number two, right here, let's assume we get assigned at expiration and at our strike price, meaning the price of ExxonMobil is above 109 by August the 18th. In that scenario, our option would be assigned and our 100 shares would be called away from us at this price, 109. If that did happen, here is what would go down. Number one, we still collect the $97 in option premium. We get the dividend, $91, and capital appreciation of $188. That's total cash flow of $376 in 14 days, which required us to buy 100 shares, so the capital requirement is $10,712. That's a return on capital of 3.51%, annualized 91.51% if you could do this every 2 weeks. I would like to call this the best case scenario. Now the truth is there is risk here of early assignment, meaning if the price of XOM goes up and above 109 before the ex-dividend date, there's a risk that the buyer of the option could decide to take assignment because they want the dividend too, in which case they could request assignment and we would lose the shares prior to this date. The risk of this happening is on August the 14th, right before the ex-dividend date. If that were to happen though, let's say that's our worst case scenario in our mind. We get early assigned and we miss out on the dividend. Well, look here, we still capture $97 in option income. We miss out on the dividend. We also though capture capital appreciation of $188 because they would only request assignment if the price was at or above 109. Total cash flow here is less, $285, but we captured that in 11 days, not 14. Same capital requirement, and our yield here was 2.66%, and our yield is lower at 88%, which is still epic and amazing, and just below our annualized yield over here of 91%. Now, quick note here, let's say you don't expect the price to go to 109 and you want to be a little bit safer. Well, you could utilize a strike price of 107. Let's switch that. And if we look at 107, we've got option premium of 180, we'll call it $187, right in between the bid and the ask. So let's go back to our two scenarios here, but with this new strike price of $107. In that scenario, if the price is above 107, and we do not get early assigned, meaning we actually take it all the way to expiration, the 18th, and get assigned at 107, well, we still collect our option premium of 187. We also collect the dividend of 91, and we have negative capital appreciation here because our strike price is below the current market price. But again, we were compensated for this 12 cents right here in the option premium, so it's all just netting out to 266 total cash flow in 14 days. This yield here is still 2.48%, annualized 64.7%. So it's definitely not 91%, but it's still really great yield. And if we were to get assigned early on this one, meaning that the option buyer decided to take the stock from us on August the 14th, we'd still collect 187, no dividend, and we lose that $12 in capital appreciation. But the total cash flow here is still 175 in 11 days, which is a yield of 1.6%, annualized 54.21%. This is still a winning trade in this scenario. And here's this trade that I already entered in the Patreon community. Here were my specific details. I bought the stock on August the 2nd at a price of $105.24. So it's already gone up since then. And my strike price is $107, expiring on the 18th, and I collected $1.13 per share with the option premium. So my scenario was 82% if I get assigned. If for some reason though I get early assigned at the 107 strike price, then I'll still collect 113 in option income. I'll miss the dividend in that scenario, but I'll also have capital appreciation of 176 for a total of 289 in 13 days, which is a 2.75% yield, annualized 77%. All right, next stock we're looking at here is one that I also have jumped into, and that is Starbucks Corporation. Ticker symbol SBUX. Currently trading at 102.33. The next dividend is coming up on August the 10th, 2023. Current dividend is 53 cents per share. And again, ex-dividend date August the 10th, which means we have to own it by August the 9th to take advantage of this trade in some way, shape, or form. We've also got our option income, the option chain for Starbucks. Now in this scenario, it's a little bit interesting. We could utilize either August 11th or August the 18th, because if we come back up here, we see the dividend is paid right before August 11th. Either one of these is going to be okay. If you utilize August 11th though, you do run a little bit more additional risk of early assignment, because if that price is above the strike price, you will get assigned no matter what prior to the ex-dividend date, because there's only 2 days left for that option income. Or if you went with the August the 18th, the likelihood of early assignment is lower. Let's utilize first August 11th, and then we'll look at a scenario with August the 18th. Let's assume August the 11th, we're gonna go with just outside of the money. So we'll go with 103 right here, at which point we'd collect, we'll call this 88 cents. Okay, so we've inputted all of our details into our dividend capture calculator. We've got today's date, the ticker, the current stock price. And we're going to assume we buy it at the current stock price. 100 shares. Dividend is 53 cents quarterly, but that's the dividend we could get paid. Ex-dividend date, strike price, option expiration date, and option premium. Again, we always have the risk that the price of Starbucks just drops hard and we do not get assigned at expiration or early assigned, and we just have to hold the stock longer. This is why you have to believe in Starbucks as a quality dividend stock, which I do. If we get assigned at expiration and at our strike price, in that situation we'd collect $88 in option income, $53 in dividend income, and $67 in capital appreciation for a total of $208. And that would happen in 7 days. It would require us to utilize capital of $10,233, which would be a yield of 2.03%, and an annualized yield of 106%. The timing of this one have to work out pretty well though. We'd really want this scenario to happen right at the last second, meaning we want the price to stay below 103 until the ex-dividend date, and then we want it to pop after that, which is not necessarily likely, but it's still a really great yield if it does happen. Now, if we get early assigned, meaning that on August the 9th, the buyer of the option is able to or chooses to take assignment because the price is at or above 103. If that early assignment occurs, we still collect the option premium of $88, no dividend for us, but we do collect capital appreciation of $67, which is a total cash of $155 in 6 days, which is a yield of 1.5%, but an annualized yield still of 92%, which is still an amazing yield. So even if we get early assigned, no big deal, move on to the next one. Now let's say we wanted to move on from a different expiration, we wanted to utilize maybe the 18th instead, which makes early assignment a lower risk. We'll still work with the same strike price of 103. In this scenario, we would collect $124 here, right between these two. If we held the stock all the way to expiration and got assigned at 103 because the stock price was at or above 103, we'd collect $124 in option income, $53 in dividend, $67 in capital appreciation for a total of $244 in 14 days, which is a yield of 2.38%, and an annualized yield of 62.17%. And this is dropping because we're holding the stock for a longer period. But let's not forget that 62% is an amazing yield. However, if we did get early assigned in this scenario where the option buyer decided to take ownership of the stock in advance of the ex-dividend date, we'd still collect $124 in option income, no dividend, and $67 in capital appreciation for a total of $191, but we only held the stock 6 days, which would lead to a yield of 1.87%, but annualized 113%. In this strategy, in this scenario, I would say this is the scenario that would most likely happen, though this one could happen. And here are the details that I posted in the Discord channel prior to today for our community. I'm in on the trade at 102.19, and I've got an option expiration of the 11th, with an option premium of 104 per share, or $104. Here are my two specific scenarios. Number one, I get assigned at expiration and at my strike price, which is the best case scenario for me. I collect $238 in cash flow in 9 days with a yield of 94.45%. Or if I get assigned early, my option income will be 104, $81 in capital appreciation for a total of $185 in cash flow, but in 8 days, for an annualized yield of 82.6%. I put out opportunities like this, it seems like every week in the Discord channel, so make sure to take a look at that and see if it makes a lot of sense for you. Again, details are down in the description below. Hopefully you found some value in this video. Make sure to leave your 2 cents down in the comments below. It's my goal to respond to every comment left on the day I post a video. That's all I got for you guys in this video. Have a great rest of your day, and thanks for watching.